Okay. All right, so hopefully you are logged on and ready to go. I need this so that they can. We're going to talk briefly. Last thing we did was our test, right? Okay, so if I put some grades in, if you do something and you need me to grade it, you know, if it's past due date, I will extend the due date, and then you guys email me when you're finished. And then I know I need to grade it. I don't get like notifications, you know what I mean, where it says you're finished. So anytime you can do that, that's great. Okay. I was going to, and I don't think I stapled them. Crap. I gotta give you some sheets. I'll give them to you in a minute. I might be able to, I'll staple them. You don't need them yet, so I'll staple them in a minute. Okay. This is our counting equation, right? Assets equals liabilities, owner's equity. Last chapter, you put pluses and minuses where things would increase and decrease. Okay. We're going to go through some notes. Obviously, a lot of that isn't incredibly practical. Pluses and minuses all the time, just by the simple fact that you have so many transactions. Okay. So there's a couple things. Assets and liabilities. We're going to have this thing called a T account. It's just a way of trying to learn the beginning of accounting a little easy. Just a little tool. Okay. Everything on this side needs to equal these two combined. That's what's up with plus. All right. We're going to go over section 12.1, 12.2, and 12.3 today. Okay. 12.1, 2, 3, they all go through some different things. Assets are cash, supplies, accounts receivable, and prepaid insurance. And then this would be, each one would have the little T account. Okay. And again, you're good to this. I'm going to kind of show you. All right. These are different assets for different things. I abbreviate accounts receivable for prepaid insurance. But instead of doing pluses and minuses, we're going to have things called debits and credits. Debits are on the left, credits are right. We'll talk about it. We want to know that you increase with the debit here and you decrease with the credit for all assets. Okay. So instead of pluses and minuses, we'll start saying debits and credits. So then next chapter, we'll take what we learned this time and put it into what's called a journal. Okay, so we're just building. Accounts payable is a liability, meaning it's a bill. You increase accounts payable with the credit. It's on, you know, if you had a little dot, it's on this side of the accounting equation. So left side for assets, so everything on the left is increased. Accounts payable is on the right side, so we increase it with the credit side. We'll get to all this. I'll show you all this. Okay, owner's equity then is like capital. Well, I don't want to write there. Okay, we're going to have a lot of different things with capital. Capital is going to increase, and what that means is investments. Okay. So when you are an owner and you invest in your own company, that's a good thing. You want to increase your own capital, your own sweat equity, right? It's hard-earned money you put in it. So any investments are capital. But we want to break owner's equity up into a few things. And so we're going to have an account called sales. Okay? And sales goes up, that's good for your business, right? The idea of having a business is to provide a service or a product and make some money, right? You want to do some good with it, but you also want to be able to support your family and live a little bit. So you're going to have like sold services or goods for cash, and you're going to sell services on account. That's kind of a phrase we'll use. Now we're also going to lower owner's equity. Okay. And we're going to do that by paying Bill some expenses. Okay, so if this is all owner's equity, how is owner's equity? Owner's equity normally is increase with that and decrease with the debit. Okay, and so we'll talk about it, but how do you decrease owner's equity account? Expense, debit. We will debit expenses, and that will lower your owner's equity, and we'll kind of show you that. What else will lower owner's equity? This thing called drawing, where you take money out for personal use as the owner. Okay, so we got these 4 asset accounts we're going to talk about. We got accounts payable, which is a liability. And then we have these 4 owner's equity accounts. 2 increase it, you increase owner's equity with the credit, and 2 that decrease it with a debit. And that's what I just gave you a big quick overview of the chapter. So that's what we're going to do. So we want to go over this now. We'll kind of get you all started. You guys that I'm recording this for, I'll give you a sheet that'll show you all that in a bit. Good. So you want to bring up accounting, and let's bring up 2-1, and let's go through some notes. And it's too big. Oh, jeez. It's like 6 sizes too big. Okay. So it says analyzing transactions and debit and credit parts. All right, perfect. Shows the relationship between the accounting equation, debits and credits. So we're going to learn about some stuff here. And I just gave you a real quick brief overview of it. All right, so we have what's called the accounting equation. Last chapter, it talks about how we analyzed and talked about the accounting equation. We're going to get into practical uses of stuff, and one of the things is because companies use so many different transactions, it's going to be cumbersome. It's not really possible to do what we did last chapter, plus minus for everything for everyone. We're going to have to get it onto forms that we can make financial statements. And so how are we going to get them onto forms? We're going to learn debits and credits so we can journalize. So today we're going to learn that stuff. So the assets are on the left side of the accounting equation, liabilities, owner's equity on the right, they got to equal. So we kind of talked about that. These are review on assets. They're things of value. Liabilities are things that are claims against you, like you owe money. Equity is the stuff that you put in, the investments, all your sales, and then all your expenses and withdrawals come out of it. So that's kind of just a rough overview, okay? We usually don't spend any time on those this year, okay? Now, a lot of times, there's exceptions to a bunch of rules, right? This is one that there is no exception. A debit is always going to be on the left side for us in accounting 1. Credit, the credit side will always be on the right side, and it'll never change. Debits are on the left for all assets, these and these. Credits are on the right side for all liabilities, equity, assets, doesn't matter, okay? So they have these things. The accounting device used to analyze the transactions, a T account. That's what I was kind of writing there. You put the account name, cash or accounts payable or sales, the account name above it, and then we kind of decide what side's debit, what side's credit, what side increases, what side decreases. Okay, so all these transactions need to balance out. The equation needs to equal. So we will often have a debit for one account and then either a debit or credit for another. You might have 2 credits together, you might have 2 debits, you might have a debit and a credit, but as long as the accounting equation equals. Okay, I gotta sneeze, that's why I'm trying not to. Okay, Here's, we already talked about this. The amount on the left side is called a debit. The amount on the right side is called a credit. We used to abbreviate everything. Like when I ran on the board, it's hard to have it to break. The prepaid insurance was just PPIN, IN or INS. All right, accounts receivable, we never wrote all the word account. We'd wrote ACCT or ACT, you know. A lot of times we put REC, you know. So there's abbreviations. If you ever see a DR or CR, that's debit and credit. All it's telling you is debits on the left, credits on the right. Okay. This chart is fantastic. This chart, oh, I forgot to show you. On Google, for the summary of our week, I have a bunch of stuff here. Okay. 2-1 notes. I have all the notes highlighted. They're screenshots, so sometimes they're small, but that chart's there. You have it. It's available to you. There's 2-1 work together. If you get lost or something or you want to review it, I walk through the work togethers. Same for 2-2 and 2 this work together. These are what we're talking about later. But these notes, this chart is helpful. Okay. So if you need that, I gave it to you. It's also in your book here. Okay. This chart's fantastic because it talks about assets, debit, credit, liability, debit, credit, owner's equity. You just got to do the reps. You got it. It's just over and over. And some of you guys will go, I got it. I got it. Others don't know. So we're all, oh, sorry.
Oh, it's okay.
We're always trying to remember. There's going to be things on one side that increases and one side that decreases, like I showed you on the board. Assets are on the left side of the accounting equation. They increase on the left side of their T account. Liabilities are accounts payables. They're on the right side of the accounting equation, right? So they increase on the right side. Owner's capital account is on the right side. Capital is like equity. That's part of the equity family, right? So capital increases on the right side, decreases on the left. Okay, so that's what they're talking about. There's this thing called normal balance. What is a normal balance? A normal balance is another way of saying increase side. So if we're saying normal balance, it's a synonym for increase side. Okay? Thank you.
Yeah.
You too. So the normal balance for an asset is a debit. Why? Because it increases over there. The normal balance for an account payable is a credit. The normal balance for capital is a credit because it's the increase side. So a lot of times they'll say the increase side, okay, you know what it is. They might say the normal balance side, and you go, okay, that's the increase side. They just use the phrase, okay? This is just telling you what I just talked about, okay? Accounts decrease on the opposite side of their increase side, true or false? True, right? If this side goes up, then this side's got to go down for our T accounts. And they talk about, therefore, assets decrease on the right side, okay? And it says liabilities, owner's equity decreases on the left side. Correct. Because it's the opposite side of the normal balance of the increase side. This chart's helpful in deciphering things. So we're going to be asked questions and we're going to want to put on the top the account name. And if we get cash and we put cash is an asset, so how do we increase it? We would debit it, put it on the left side. If I paid Elliot money, I would credit cash. I'm paying him cash. It's an asset. How do you decrease cash? Credit it. That's what we're going to do in our problem. Okay. So let's go look at 2-1 work together. You can always do these things on your own. It don't matter. But we're going to do the work together. We're never going to do the on your own this year because of the way a class is set up with the less time. You're always more than welcome to do them. Just practice. Okay, but we're going to do the work together. All right, fantastic. I'll zoom in a smidge. All right, so it says for each T account, our counting device that helps us learn it, we need to label, debit and credit increase side, decrease side, and the normal balance. Well, we just told you, how are we defining normal balance? It's the increase side. So this isn't going to be too bad, right? All right, so cash. What we say is never going to change. Every account debits on the left side, and every account credits on the right side. These first three are all assets. So they're things of value. Accounts receivable is things of value. They owe us money. So debit on the right side, credit on the left side for cash. Where's my stuff? I'm going to zoom this in so I can show you how this chart can kind of help you if you want. Okay. So if I had a question, for sure, oh, I don't want to do that. I can't. All this stuff is in there. All right, there. Okay. So cash is an asset. Debits on this side, credits on this side. Cash has a normal balance on the increase side. That's a debit. So we will increase over there. We decrease on the right. Assets are on the left side of the accounting equation. So we increase on the left side. Normal balance is a synonym for what side? Increase side, the debits. So does that make sense what we're doing there? And why are we doing it? We're trying to get the hang of it. This is all brand new. It's like learning German, kind of. You're learning the language a little bit. Accounts receivable, debits and credits. Debits are, accounts receivable is an asset. Debits are always on the left. Credits are always on the right. Assets are increased on what side? The debit side. Assets are decreased on, on the credit side. What we say normal balance is? The synonym for increase side. So debits increase, so the normal balance is a debit. So the next two are assets again. So you know what you're doing. Debit on the left, credit on the right. Increase on the debit side. The opposite side of increase is decrease. Normal balance is synonym with the increase side. There's all this kind of, sort of, you kind of getting it a little bit. It's going to be weird because it's like, what are we talking about? What's a debit? What's a credit? But that's how we're going to be understanding it so we can journalize. But you guys got it? All four of those are assets. We're always going to have the debits on the left and credits on the right. All the assets will always increase on the left and decrease on the credit. The normal balance is always going to increase, be the increase side. So the normal balance for debits will always be the debt, or assets will always be the debit. You got any questions with those four assets? Okay. Accounts payable, we got two of them here. What side of the accounting equation is accounts payable? They're liabilities. They're on the right side, correct? Okay. So they're on the right side here. They're liabilities. Accounts payable, and liability are the same thing for us. So what do we say are absolutes? Left side debit, right side credit. Absolute, doesn't matter asset or liability, right? Accounts payable is a liability. It increases on the credit side. Opposite of increase, decrease, right? So I get used to it. What we say normal balance is a synonym for the increase side. So for accounts payable, credit. Cool, cool, cool. So this accounts payable, and you're like, why do we have two accounts payable? Well, our company is going to buying stuff and charging it to these guys, and we'll pay them later. They'll bill us. And we're also charging things to Ocean Supplies, and then they'll pay us too. Okay. Liability. Always, every account always has a debit on the left, credit on the right. Increase, you can see on that chart, this Google Doc, that's in your book, that's on our Google. Increase with the credit, decrease with the debit. Normal balance is a synonym for credit of accounts payable, the increase side, which is the credit. Parker Vogel Capital. Debit's always on the left, Credits on the right. Who's Parker Vogel Capital? That means it's the owner, right? Capital is owner's equity. It increases on the credit side. Owner's equity is on the right side of the accounting equation, so it increases on the right side. Decreases on the opposite side. Normal balance is always the increase side, which is credit. Questions, comments, concerns? Good to go? All right. Let me zoom out because this is so in my face here. Go down here to apply your understanding and knock out application 2.1. And again, where do you have this? It's in your 2.1 notes off of Google. I think it helps. You can use it. It's off of this week. And it says 2.1 notes. There's a bunch of stuff. I put 2.1 notes, 2.2 notes. But this chart I think is helpful. And don't think it's not cheating. It's understanding what the heck they're talking about. Okay. So if I was doing this 2.1 app with you, is it weird? Okay. So all you're going to do is tell them if this is an asset, liability, owner's equity, what side it increases on. So you got it right here. All assets increase with the debit, all liabilities increase with the credit, all the capital increase with the credit. So you would say, so cash is an asset. It increases on the debit side. It decreases on the opposite side. What's the normal balance always going to be? The increase side, right? So this column, normal balance, 7 and 8 will always be the same as 3 and 4. 5 and 6 will always be opposite. Okay? Use that chart. It'll help you out. Why don't we see where we're at in about 8 minutes? 12:45, we'll go over section 2. And I want to staple these because we're going to use these next. You can help each other out, talk it over. And I'm not going to try to be mean, but I'm going to tell you, if you ask, how do you increase an asset? I'm going to go, do you have your notes up? They're right there. Do you have your book up? It's right there. It's telling you. You don't need me to tell you. Assets are on the left side of the accounting equation. They increase on the left. I'm going to give you some sheets too. What do you got? Absolutely. Under apply your understanding. I can't remember. I started talking about it and I let go on. Did I do something? Yeah. You doing okay? Hold on. That's right. No, well, because that chart. You can see the increase out here for all the assets. And the liability increase side on the other side. Capital increase side on the other side. This chart of how. So like what I wrote on the board up here. I'll raise this up a little bit. So assets are cash, supplies, accounts receivable, and prepaid insurance. So when they come up on this thing, what's accounts receivable? It's an asset, it's something of value, okay? So that's how you classify those. Asset, 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 asset. Accounts payables are liabilities. Okay, so that's how you'd say that. How do you increase liability? Credit. So the normal balance for these are credits. The normal balance for these four are debits.
That's another question. So for example, when you buy a house and you still owe money from it, would it be a liability?
Yeah, that'll be a loan. A loan will be considered a liability. So like when you take if you ever take advanced accounting, we call it long-term liabilities. So you get mortgages, even like a car loan, we put it into a long-term because it's something that you got a 3-year loan or a 5-year loan. That'd be a long-term, but this is real basic. I'm gonna give you this. This is for you guys to learn a little bit. We're gonna add to it. Brother dropped from this class. I dropped from this class. I heard him come out. He's another counselor. That's and to the class, and the counselor, we gave I'm not you this disease. Must have been pounding on home for your mind. All right. So does that make sense? Does that kind of help you?
Yeah.
Okay. Give you a couple more minutes. You have trouble with that, Elliot, just go to view and you can zoom in. You go here to view and go zoom, you can go to like 1.25 or 1.5. That way you can see that sheet. You have a small. What the heck happened to my printer? Break it. Okay, we gotta get moving. Hmm? You see, is that printer on? That thing next to you, the printer? Is there, can you hit, it's a button right in front on the bottom right, way at the bottom. That's why it's not working. Is it clicking on? I'm like, what the hell's wrong with my printer? All right, thank you. Okay, we good with that one? Let's go over 2.2. Okay, and what we're gonna do is these sheets, see this 2.2, it says analyzing how its transactions affect accounts. We're gonna go over this account, these transactions. So what I'm going to do is I gave you one too many. I make a few mistakes throughout the semester. This is one. I put expenses on there twice. The thing you guys want to make sure you don't get hung up on is in our instructions, in our book example, they say when we pay a telephone communication, we're going to call it communications expense. That's what our example is in the book. Well, then, of course, we go right to our first problem. And what do they put telephone expense as? Utilities. We'll always tell you what the actual expense name is, okay? You're going to have like repair, you're going to have advertising, miscellaneous, rent, utilities. Usually utilities is like your folks pay utilities probably. Like Mid-America, go like the heating, electric, like Riverdale, the city of Waukee, city of Clyde, whatever, okay? So don't get too hung up on expenses. We will help you with those. They'll be in the chart of accounts, okay? I'm going to zoom this up a little bit so you can see it. Okay. This book does an excellent job here of kind of showing you. It's got all these different parts, 1, 2, 3, 4, right? All that is coming off of these. Now, I'm not going to read these to you every time. If this is after you today, if it's still something that's kind of hard, go back. This would probably be beneficial to read. You just don't have the time to read the book in class, right? This is saying I'm going to do which accounts are affected out of those lists that we have: cash, supplies, all the assets, liabilities, owner's equity. How is each classified? Kind of like what you did in last problem. How is each being changed? What is being increased? What is being decreased? Vice versa, whatever, okay? And how do you enter the amounts? So that's what this is. So when we have on our first transaction up here, it says receive cash from the owner's investment. So which two accounts are affected? Cash and the capital, Michael Delgado's capital. Okay, what kind of accounts are these? Cash is an asset. Michael Delgado is an owner's equity. This is the accounting equation. Everything on the left side of the accounting equation goes up over here. So when we receive cash, that's good for our business. That's good for Michael, the company, right? So we will debit cash. Okay. The owner's investment is capital. And you can't see it because it's under the board, but I wrote investment in capital. So how do you increase owner's equity? You credit it. Okay. And that's what, okay. Sometimes my computer jams up. So that's what we're talking about here. Each transaction changes the balance of at least two accounts. True or false? True. Okay. A list of accounts is going to be called the chart of accounts. That's on your crossword puzzle in your study guide. Debits must equal credits in each transaction. That means assets have to equal liabilities, because we're going to have $2,000 worth of debits here, and we're going to have $2,000 worth of credits. Debits always equal credits. Okay. So we're going to write on this sheet, where's my marker? Transaction 1. And we're going to put debits first and credits second. So why do I give you that sheet? I think it's a place that will help you. It's another way of putting the information down, and then you can use it on the test. You can use it on the problems right there. Okay, so when it says receive cash from the owner's investment, I'm writing cash down first because that is debited. Cash is increased. Capital is increased. Why am I writing cash first? Because the debit will always be listed first. We're writing capital second because it could be anybody's capital. Michael Delgado, next time it's Sally Peterson, the next time it's whoever. Okay. So what we're doing on this sheet is giving you a chance to understand what side. This is like the journal entry. It'd be the same as putting plus on this side, minus. Now we're putting some names and saying debits and credits. And you'll see what I mean here in a minute. But this is a T account. Receive cash means increase cash. Owner's investment is capital. So how do you increase capital? Increase it there. Capital, increase. Asset, cash, increase, right? It's the same as this chart. We'll keep doing a bunch of these and you'll get the hang of it, okay? Paid cash for supplies. All right, we got this transaction here. We're not going to read all 4 steps, but you get the idea. We're going through it. This is an example when 2 assets are changed. One is cash, one is supplies. It says when changes are made on only one side of the equation must still be balanced. Therefore, one must increase and the other decrease. You're like, what the heck are you talking about? We said this equation has to equal, right? You guys would agree. I said that a bunch of different times. Assets have to equal this. Well, if we bought supplies increased by $165, right? I got a place in my closet. It's got $165 worth of supplies. I paid cash. The minute you see paid cash, what do you know? Cash is being decreased, credit. So cash is decreased. These are both assets. One must go up for the same amount that this one goes down. That's all it means. It just keeps that accounting equation equal. So for transaction 2, it says pay cash for supplies. What did we gain? What did we increase? We increased supplies. We credit cash because we paid cash, right? One asset goes up, one asset goes down. Why am I writing supplies first again? Because it's a debit. And we're getting started. We're kind of moving to get ready to do chapter 3 by writing debits first. Okay? Kind of, sort of. We're just plugging along. Okay. Paid cash for insurance. Again, we go through those steps. If you're having a hard time, I'd read all that. Basically, it's the same thing. We are working with what accounts? Paid cash. When I see paid cash, I know for a fact it's a decrease, it's a credit. So I know cash is being credited. So what am I debiting? What am I gaining? Insurance. Insurance is gain. How do you increase an asset? With a debit. So when we see the transaction paid cash for insurance, we do prepaid insurance goes up, cash goes down. Debit, prepaid insurance, credit, cash. That is transaction 3 that you got there. And they just kind of explain what the chart says down below, right? It's not that this isn't important. It's just that, again, it just says one asset's increase, one asset's decrease. Okay. So that's transaction 3. We're not doing global business. All right, so we get to bought supplies on account. On your sheet, that's transaction 4, right? So when you see this, let's say this is German class or Spanish class or French class. Okay, what the heck are we talking about on account? What's that mean? This just means I got some stuff I want to use and I'm going to pay for it later. Okay? In the business for Michael Delgado's company, it means he bought supplies, he charged it to Canyon Office, and he's going to pay them later. When we buy supplies on account, that means we're going to pay for it later. So when it says on January 5th, bought supplies on account from Canyon Office, is the word cash used there at all? No. So we are not using cash in the transaction. We've used cash in all 3 of these so far. But not when it says bought supplies on account. What are we buying? What are we gaining? The asset supplies, right? And what's this? The account Canyon Office supplies. A payable is the same thing as a liability. And so a liability increases with a credit. So we debit supplies for $220. We credit the account payable. Again, what's account payable? Amounts to be paid in the future for goods and service required already. Buying supplies on account means I get this stuff right now and I'll pay you later. Okay, so for that transaction 4, we are gaining or increasing the asset supplies, so that is a debit. And we are increasing a new bill. It's a liability, accounts payable. Hope that's easy to see, sorry. Kind of crowded. Supplies goes up with the debit. It's listed first, so that's why we have a debit. And I believe this is the last one for this section. 5 transactions. Paid cash on account. What did we say before? When I bought supplies on account, this means I got stuff, I'm going to pay you later. Well, now we're dealing with Canyon Office Supplies. I'm paying you on account. That means you had a bill, now I'm paying you. On account means I'm taking that bill off. When you buy supplies, it means I'm increasing a bill. I'm going to pay you later. Now I'm paying you later on that bill. Okay? So when January 9th comes around, we see paid cash. What do we know we're doing to cash? Decrease. How do you decrease cash? Credit. Accounts payable, we want to decrease. Why? Because before we increased our bill $220 over here, right? Well, shoot, we don't want to, we just paid them. I don't need to pay you $220. I got to keep track of this. So we paid them $100. So now our bill is only $120, right? You know, you got to, it evens out. So when it says paid cash on account to Canyon Office, it's just one asset and one liability change. This is all describing, that's the same thing. You record a decrease on the opposite side. When we do this, we write down the debit first. So account payable, our bill is going down because we paid. What else is going down? Cash, because we paid. Okay, that's section 2.1. Again, this chart helps a little bit. These charts help a lot. So when there's a question, you're gonna go, God dang that Kenny is, he's a fat jerk, whatever. He's not helping me. No, if you ask me a question on paid cash to account for, on account, what am I gonna tell you? Look at transaction 5. You should have wrote it down. Look in your book. It tells you paid cash on account, decreased accounts payable, decreased cash. Okay, we just gotta start, we gotta do it. And that's it. So let's go look at the work together. You guys are rock stars, appreciate it. I know it's Friday. Like, what the hell are we doing all this work for? Because we're learning. Plus I got golf meets next week and I'm never in school. So you guys are gonna, next week when you come, you're gonna, what day do you guys come to school? You in class here Monday? Well, me and Cody won't be here. I won't be here Wednesday. Cody, you'll be here until 1:30. All right, work together. All right, so here's how I do these things. We have these directions for, I hit this little pin in the top right corner. I click on that pin guy, and then I can move my directions along with me. Does that make, you know what I mean? That's all. I just hit that pin and I'm able to move it. Again, I'm still got this directions up here, or these instructions from 2.1, because it kind of helps me. You got your sheets. And so what we got here, it says prepare 2 T accounts. These are those accounts that help us, the accounting device that help us. This right here, if you see where I move my cursor under account titles, this is that chart of accounts they're talking about. Okay, it's a chart of accounts, just basically lists everything you're going to use. So it says Jensen Cleaning Service. So when John Jensen invests capital, you're going to use that account. You can see there's no there's different expenses here. There's accounts receivable, accounts payable. So if you have a question, go back to this tab. All right, so then click on this transactions tab and you'll see what we want to do. It says prepare these T accounts, how they're being affected. So March 1st, receive cash from the owner's investment. Number one on your sheet. Received cash. When we receive cash, we debit cash, right? Owner's investment is capital. That's his sweat equity, that's his money, that's his investment, that's an increase in capital. I can't remember, look on the sheet. Capital increase with a credit. Cash increases with a debit because it's an asset. Get out of the way. Okay? Next one. On the 3rd, paid cash for supplies. Transaction number 2. What two accounts are affected? Cash and supplies. They're both assets. What are we gaining? Cash or supplies? We're gaining supplies. Why am I writing supplies first? Because it's debited. The debits go first. We wrote cash up here because we debited cash. We wrote supplies here first because we increased the debited supplies. And then whenever you see pay cash, you know it's cash credit, right? We're lowering it. Okay. March 4th, bought supplies on account. That's transaction 4 now. So that's right here. It's on your sheet. It's on the board there. So March 4th, it says bought supplies on account. Which two counts are affected? Supplies. And it says supply depot. So if you go, I can't remember, that's accounts receivable, accounts payable. What's that go again? Well, when we buy supplies on account, remember our translation is we got stuff and we're going to pay it later. That's a liability. Accounts payable means I will pay it later, right? So it said supply depot. So you see supply depot here. If you can't remember, go, oh, that's right. That's accounts payable. That means I pay them. You're going to pay them later. So we're getting a bill. So we bought $120 worth of supplies from those people. And they are going to bill us later. How do you increase a payable? Right here. The liability, normal balance, increase liability, credit. We got a bunch of supplies. That was transaction, or March 4th. March 6th says paid cash for insurance. Transaction 3 on your sheet. What two counts are affected? Insurance is increased, and whenever you see paid cash, you know that's a cash credit. Insurance is something of value. You want it. It's something worthwhile. It's keeping. It's an asset. So $250 debit to insurance, $250 credit to cash. These are two assets. One must go up with the debit, one must go down. Okay. And the last transaction is March 9th. It's a paid cash on account. Transaction 5 on your sheet, if you wrote it down. Paid cash, you always know paid cash means credit to cash, right? On account to supply depot, so you go here to accounts payable supply depot. We are lowering our bill by $80. So you debit accounts payable, and whenever you see paid cash is credit. All right, all right, all right. Okay. We'll give you 8 minutes or so and do the application problem. 2-2 app. And again, you don't have to worry about these. These are not graded. These are practice. The application problems, those are graded. So application problem 2-2. I can do the first one with you if you want. I hit that pen, not all the time, but this one works. Sometimes the instruction's so dang big, it sucks. But this is the chart of accounts. We got a couple different accounts. And it says, receive cash and owner's investment. What are we receiving? Cash. 10 grand, I like it. Investment is capital. Debits listed first. What does number 1 look a lot like? Your first transaction. You got it written down in front of you. If you wrote it. Receive cash and the owner is an investment. Take another 7 minutes, see what you can do on that. won't be out front. Any problems you run into on that one? All right, we're gonna do the last section next. I know it's a lot. I appreciate you guys doing this. Next week's the week from hell. I'm never here. I want to give you all this, and then next week you can work. And then in 2 weeks, we'll take the test. We have plenty of time to do stuff. Okay? Analyzing transactions to owner's equity is this 12.3 section. So again, I know it's kind of hard with the slide on. Owner's equity is over here. Owner's equity is increased with the credit, right? We have a couple, where's my putter? Oh, man, I'm not in the way. Okay, capital is an owner's equity account. Capital is increased with the credit. Investments are capital, like that first transaction. The owner invests receive cash from the owner for investment. That is an increase to capital. How else do we increase owner's equity? We're going to have an account called sales. When we receive cash for a sale, receive cash for services, we sold services for cash, or we sold services on account, that would mean we get paid later, right, on account when we sell services. But that is an increase to sales. Why don't we just put it all under owner's equity? Because as an accountant, you want to be able to break everything up into how am I understanding what this is about. Like, I want to know, is all our money coming in because of investments or is it because of sales? You want to know specifically. So that is how we'll increase owner's equity, with credits. How do you decrease owner's equity? With debits. How are we gonna do that? We're gonna do it when we pay expenses. Okay? Any expense we do, it doesn't matter the name, communications, or if it's utilities, or if it's advertising, whatever. We will debit the expense. It's an owner's equity account, so we debit it. What happens when we debit or increase an expense? It hurts owner's equity. Okay? What happens when you pay yourself, it would say like, pay cash to the owner for personal use. Okay, or it'll say the owner took equity out in the form of cash. All that means is he's taking money out to go, you got a trip on the weekend. It's your money, you can do whatever you want. So drawing is a debit. It will, how do you lower owner's equity? With a debit. Okay, and so that's what this section is. And these next 5, I have 11 transactions on there because I have 2 expenses. I shouldn't have done that. I should have just had 1. So this says, how is it going to affect owner equity accounts? Those are the 4 owner's equity accounts. Let's go see. Receive cash from sales. Sales is this new account. Okay. Sales, and why are we doing it? Again, I maybe didn't explain it very well. We want to avoid capital having these huge, large numbers. We don't know how it's divided. So we have this account we're increasing or decreasing, whatever. But we're starting this sales account. How do you increase sales? Like revenue. You've heard of revenue, right? So like a ball club makes revenue or a band made revenue. What are they making? Money. They're making sales, right? So revenue is going to increase sales. The owner's capital account has a normal credit balance. We already know that over here. Okay, and so this is all talking about it. Again, for this section, we have this. If it's something that's kind of goofy for you, read it. Go through it. Spend 10 minutes. This is transaction 7 on your sheet. No, 6, right? Receive cash, 6. We don't want all this out here. So 6, we receive cash. That's good for our business. From sales. Cash goes up, sales goes up. So that's what you'd write on 6. Debit cash, right? Because cash is an asset we increased. And again, the book does a fantastic job of showing, oh, I didn't mean to zoom out, sorry. Book does a fantastic job of showing you that, right? Cash, debit. So when you ask me a question again, receive cash from sales, how do I do that? I'm going to go to your book, 2-3, go to your sheet, transaction 6. Okay. Sold services on account. Again, if we're in foreign language class, we did some work for somebody, they're going to pay us later. When we sell services on account, they're going to pay us later. When we buy supplies on account, we're going to pay them later. Okay. So sold services on account. Down here it says, again, owner's equity has a credit balance, but then down here it says which accounts are affected. Well, we're going to walk through it. One's going to be called accounts receivable. Accounts receivable, we wrote down on the board, was an asset. It's something of value. Why is that? Because if I go into your store and I buy supplies from you or something, you would sell services on account. That means then you bill me. That's a good thing because later you're going to get paid. You're going to receive cash later. So when you're going to receive cash later, it's an asset called accounts receivable. When you're going to pay cash later, it's an account payable. It's a liability. So when we sell services on account, we're going to receive cash later. So that means we're debiting accounts receivable because we're going to increase accounts receivable. And we're crediting sales because we're increasing sales, right? Good things. Making a sale, that's what you got in the business. You want to make sales, you're going to bill them. There's whole big companies that spend all their time. They got people that all they do is bill people and collect money and bill people and collect money, you know. It's a good problem to have. All right, accounts receivable is an asset. Assets have normal debit balance. So when you sell services on account, that increases that company that we're gonna bill Main Street. That's what we're gonna do, right? Okay, and we record it. Nowhere is cash involved in selling services on account, correct? Cash isn't involved. Okay, awesome. Pay cash for expense. Okay, so this is where I got goofy on your sheet. Did we sell services on account? Yeah, so pay cash for rent. I had rent written down. This one says communications bill. Now here's the deal again. In this problem, it says communication bill. When we go to do the work together, it'll be utilities expense. It doesn't really matter. Here it says communication bill is when you pay for expense of a phone, but that's not necessarily the only time. Again, owner's equity accounts decrease on the debit side. We talked about that, right? An increase in an expense decreases owner's equity. True or false? True. That'll be on the study guide. That'll be on the test. How do you decrease owner's equity? You debit it. Expenses have normal debit balances, therefore debit the expense account. Even though it's an owner's equity account, expenses have a normal debit balance because they lower it. Okay, and that's what they're talking about here. Expenses decrease equity. How do you decrease owner's equity? It tells you right here to debit it. So when we do any expense, this could be miscellaneous, repair, gasoline, water, electric, advertising, whatever. Every expense, normal balance is a debit. And like always, so in our sheet, pay cash for rent, transaction 8 and transaction 9. What's 9 say again? Transaction pay cash for telephone. 9, 8, and 9 are basically you debit the expense, which means you increase it, and you credit cash, which means you decrease it. Okay, so any expense, debit the expense, credit cash whenever you pay cash for an expense. Don't get hung up on communications expense because usually it's telephone expense. And then one time it's utilities expense. But most of the time, we'll be able to help you. That's not the confusing part, the name. As long as you understand that expenses are part of owner's equity, expenses have a normal debit balance. So expenses decrease owner's equity. Okay. Receive cash on account. So what's this mean? Main Street here. Scroll down. Main Street is writing us a check for $200. Well, what'd we say 2 transactions before? We increased Main Street's bill by $500, right? So whenever we sold service on account, we did $500 worth of work for them. So we billed them $500. So we debited accounts receivable. Now they're coming back and they're writing us that check for $200, so they're paying part of the bill. So when it says receive cash, we write, well, we're debiting cash, right? So 10 is cash, debit, and they're lowering their bill. How do you lower accounts receivable? You need to credit it. Accounts receivable is an asset. Assets normal balance is a debit, meaning they increase on the normal balance side. They're paying off a bill, so you need to lower their bill. Now they only owe us $300. Before they charge us $500. And that's why you need somebody in charge of that, because somebody calls and goes, how much do I owe? If you got a company that goes, I don't know, shoot, then you're getting screwed probably, right? You want to know. They should tell you. So you need to have that all on track. That was transaction 10. Last one, paid cash to owner for personal use. I have it written that way on our sheet. But then they word it this way. Oops. Get out of there. Get out of there. Sorry. Withdrew equity in the form of cash. So if you wanted to write down there above this, that withdrew what did it say? Paid cash to owner for personal use, where the heading says paid cash to owner for personal use, that is the same thing as saying withdrew equity in the form of cash. So just so that you say, wait a minute, it's not on my sheet. Yeah, it's supposed to say pay cash to owner for personal use or withdrew equity in the form of cash. And all this means is the owner, Michael Delgado, withdrew money. And we wrote down right before, we said drawing is an owner's equity account. Again, we're in owner's equity. How do you increase it? With a credit. How do you decrease owner's equity? With a debit. Drawing is going to be a debit balance, meaning it will decrease owner's equity. That's what we're talking about. So we have this new account, whoever the owner is, whoever it might be, and then the word drawn. So our last transaction, 11, withdrew equity in the form of cash. Ow, jeez. That's spark. Drawing, increase, cash, decrease. I know that's a ton of stuff. You guys are rock stars. But that is our section. What is that today? What time we get out of here? 35? Like right now? Is that right? No, we get out of here 40. I looked at the wrong sheet. An increase in withdrawals decreases owner's equity. True or false? True. That'll be on your study guide. That'll be on your test. Withdrawals have a normal debit balance. One of the things in your crossword puzzle in your study guide is, what is a forensic accountant? It's on the next section. We don't really spend any time on it, but this is a word that's on your crossword puzzle. All it is somebody, it's an accountant who knows the numbers. They investigate and find like fraud. Like if you guys gave me your money to invest and I went and spent it on a bunch of crap and I give you false reports or something, I take your money, but I don't use it like I'm supposed to, it'd be fraud. So we have people that would look into that. Forensic accountant. It's one of the crossword names. Okay. But that's awesome. You want me to help you with work together the next 5 minutes, or you guys want to do that on your own? I can help you real quick. I know we only got 5 minutes, so I don't know if we can even get it done, but I can fill them in for you. I'll do it quick. Sold services on account. The good thing is you got them written down on your sheet. So sold services on account is transaction 7. Accounts receivable for 125 and sales for 125. Receive cash from sales, transaction 6. When I receive cash, you put it in the debit. When you receive cash from sales, you put it in the, oops, what happened? Put it in the credit. Increase, increase. That's transaction 7 and transaction 6. March 14th, paid cash for telephone bill. That's either 8 or 9. Now, what is the telephone bill? See, this is what I was talking about. Last time in your chart of accounts, last time they said telephone bill was communications expense, right? Well, you see a communication expense, there isn't one given to us. So we're going to put it under utilities. It's kind of silly, so don't get hung up on that. But we got to pay our telephone bill, so we're putting it under utilities for right now. The 16th, it says receive cash on account. What transaction is that? That is transaction 10. Whenever we receive cash, what do you know you're debiting? Cash. Over here, remember we debited accounts receivable? We did a $125 job and we're billing them. meaning we will receive cash later, so it's an asset. Well, now is later. The 16th, they're paying us $125. What are they doing? They're paying their bill off, right? Oops, dyslexic. So up here, they charged us $125. We're going to receive it later on the 11th. They get it, we bill them, they get the bill, they pay us. Cool? And then the 19th is the last transaction. Paid cash loan for personal use is the same thing as paid cash to the owner for withdrawal of equity or withdrew equity for cash. That is the drawing account. So the owner's just taking cash out to go, he's got a weekend. He needs some money. All right, then. Truly awesome. I appreciate the busy Friday. We are Team U. Odd. So we'll be here Wednesday. So next Wednesday I won't be here. But what you're going to be asked to do, you can do the app before then. If you can do 2-3 app before next Wednesday, that'd be awesome. If you can't, then you're going to have to do it in class. But we're going to give you the study guide, which is open. The study guide to do. It's right here in the study hall. You're going to be asked to do the study guide. So that's some terms, right? No big deal. You're going to be asked to do, you're going to be asked, so here, on the study guide, receive cash from owner's investment. You're going to have to put the letter of what it means. We debit cash, credit, capital. So cash is A, capital is F. Help each other out with that. But that's part of the study guide. I don't want to, back to assignment. True, false questions or multiple choice questions, I guess. A, B, C, D. These are the ones. Increase, decrease, debit, credit, increase, decrease, normal balance. It gets confusing, so they'll write them down. And then here's the crossword puzzle. So like 5 across, forensic accounting or forensic accountant. So you guys will have, if you can get 12-3 done before next Wednesday, that'd be great. And then next Wednesday, you're not learning anything new. You're just going to work the whole time. Yeah, bud. Have a good one, man. See ya. Oh, yeah. Whose class is you in? Lady or guy? Marcy? All right. CR. Cody Easland is going to take a test in here he missed. He's up here now. See you. Have a good weekend. Thanks, Hank. Okay, so what period is this? 5. This thing is so big. Oh, I gotta stop recording.